All right, Quasar Markets Live. Kevin Green, you all love him. Schwab Network. Got him right here at Quasar Markets Live. Hey, let's go, man. Kevin, the president of the United States just started screaming at Department of Justice, saying, "Hey, I didn't do this." Carolyn Levitt says, "Hey, I didn't try to sue the chairman of the Federal Reserve." Talk to me. What's going on, Kevin? That doesn't seem right to me, man.
Yeah, look, it's a unique situation, and I think obviously this is untested waters at this point in time. But the market is actually kind of shrugging this off. We did see the yield complex testing that 4.2%. If you're looking at the 10-year Treasury futures, and we're kind of sitting at around that level. It's a key resistance area. Technically speaking, would not be surprised if we kind of break above that 4.2, maybe even test 4.6 during this year. But obviously, it's a very unique situation. But I think the market right now is pricing in the fact that it will take some time, not only when it comes to an investigation, but also bringing charges, going through the court and legal process that could take 6 months. It could take a year. It could take 2 years, Stephen. Similar to the Lisa Cook situation as well. Once again, very unique. We have seen that also being drawn out here over time, and the market kind of overlooks it, at least for now. So I know that it's the video from Jerome Powell was very interesting. I saw that yesterday. It was very interesting, but I think the market for now is kind of discounting the fact that I don't want to say that it's not serious because I don't want to put it in that light, but I think they're discounting the time factor of any type of repercussions from what might be happening here on the legal front.
Yeah, I think you're right. It's interesting when I look at it from the perspective of the DOJ. I mean, they just out of the blue, right, on the weekend, and the White House will call it "take out the trash," and this is not taking the trash. This is actually name calling, and this is a whole different ball of wax now when it comes to the Federal Reserve. On top of Venezuela, on top of Cuba, on top of Iran, Iraq, Israel, China, Taiwan. I mean, my God, name a country and it's probably got some kind of issue going on with the United States, including Greenland. Talk to me about Greenland a little bit. Is this real, or is this just another nonsense going on here?
I don't know. It does that, just going off the news reports that the Europeans are definitely taking this a lot more seriously than what we've kind of heard maybe over 2 or 3 months ago. So there are maybe some movements that we will see, and we'll see how this actually pans out. I think if you're looking at it from a market dynamic standpoint, could it have a massive impact? I mean, it could. Just depends on how it actually does resolve itself. You can make the case of strategic location on a military front. I won't go down that route, but I think the Europeans are definitely taking it serious. I'm not sure if the U.S., as far as the markets itself, is taking it serious or not. But if you kind of go and look at the past and just kind of talking about dollars and cents here, this is a very unfortunate thing, and I think you and I have had this conversation before. Generally, when you start seeing geopolitical risk events coming to the forefront, or you do see military escalations that take place, usually we do see an immediate impact to the downside when it comes to the equity markets. But over time, it actually does provide a bull case for equities moving higher, and a lot of that is because of defense spending and things of that nature. Consumer spending, usually favorable fiscal policy, also coincides with that. That's just a fact of history. Favorable monetary policy usually also coincides with military conflicts. I'm not saying it's the key thing that you want to have happen, but I just given the context that the market right now, I think, is discounting a lot of these items. And I think if you look at the S&P 500, Stephen, we do not do well when VIX is sitting at 14, 13 for too long. That's usually when we don't have really structural foundation or support for asset values. Usually we thrive when we have a little bit of uncertainty, climb that wall of worry, and then continue to move us to that next level. And unfortunately, from a political standpoint, you may like what's happening, you may not like what's happening, but from a trading standpoint, there's an equilibrium that you want to be able to watch for when it comes to volatility and the events around volatility that could give the market strength. Right, wrong, or indifferent morally, it's all about dollars and cents that we kind of talk about here. And I think that's continuing to be the reason why we see these dips, being bought. Yes, there is a problem. Maybe it's going to be resolved. People buy those dips, right? Tariffs, it was an issue. People buy those dips. Regional banking crisis, people bought those dips. It's just kind of a creature of a habit right now until something actually does break. We don't have anything that's fundamentally breaking at this point to really kind of
Yeah, but
slap
you
the
know
bullet
what?
on the hand here.
Yeah, no, I totally get it, Kevin, and I understand it. And it, but if this was 10, 20 years ago and all these things were happening, the markets would be like, oh, hell no. Now they're just like, whatever, we're going to keep buying whatever is thrown at us because we're okay with it. And the market's fine. And that doesn't always pretend to be good, right? I mean, I've never seen a market like this in my entire life.
Yeah, well, it depends on the landscape. When we talk about these markets, sometimes we bundle everything together and try to come up with some type of notion as to why markets are moving higher. And in fact, I had a DM from somebody I got to reach back out to. I know they're probably watching this, but they asked me the other day, like, why is the market making new all-time highs, giving all of these events that are taking place? It's because there's a lot of different areas of the market or pockets of the market that still actually have some very positive catalysts taking place right now. And if you're looking at it, 10, 20 years ago, if we had a situation like we have right now, you're right, Stephen, right? We would see probably a bigger event, at least for now. We would probably have an aggressive sell off in some fashion, especially when it comes to the treasury markets, looking at 10 years, 20s, 30s. The longer duration probably would have had a little bit more of an impact. We do have some treasury auctions taking place. Now, because of the event that occurred over the weekend and the fact that we had a 10-year auction today, which actually went pretty decent. Bid to cover was good. Yield was pretty much, for the most part, matching the when issued market, which is good. We'll have a 30-year auction, I believe, on Wednesday, if I'm not mistaken. But maybe let's look at the next one. The next one that kind of, once we start kind of having a lot of these news items, especially this one about the Fed, starts to bake in a tad bit, do we start seeing foreign buyers of treasuries starting to back out here a tad bit, pushing yields higher, right? That's going to be your main catalyst, or that's going to be your main telltale sign. But I think there's so many pockets of individual strength in this market that's providing cover for some other areas that may have weakness. And I just want to throw a couple of those out there. The industrial sector, we have talked about ad nauseum. Everybody is, Caterpillar doing a phenomenal job. Boeing, obviously, seeing some tailwinds. But if you look at some of these other companies, Deere and Co., it's stealth. It was a stealth mover last week, Wednesday, Thursday, Friday. Look at that chart. If you're looking at even, the material stocks, which a very small portion of the S&P 500, but if the metals trade's going to work, if the commodity and the physical market trade is going to work, that's a sector that's going to provide a little bit of alpha. And then look at consumer staples. Today, strongest sector performer today. You see Costco moving to the upside, Walmart catching a bid because of some news. But you also maybe have some of this optimism that the Supreme Court come out maybe on Wednesday. That's the next announcement. Maybe they come out and they strike down some of those tariffs. Maybe not all of them, but some of them. And I think that's probably going to be a positive catalyst for a lot of these sectors that have been able to try to manage the tariff policy, but now might see a little bit of cover there. And I think that type of positive catalyst, the start of the year, the rotation that's taking place, selling out of tech in certain pockets, getting into, once again, industrials, consumer stable, that rotation is giving us the foundation and the sticking power for us to stay at these levels. And I think that power itself for today and maybe for tomorrow and maybe the next day is enough to try to hold this whole thing together while we have some of the other news items, the flashy news items kind of play in the background.
Yeah, and I
That's
and I
I
moved everything to
yeah.
materials not too long ago, and I moved everything to international not too long ago as well.
Yeah.
And the dollar. Real quickly, Trump just said, effective immediately, any country doing business with Islamic Republic of Iran will pay a tariff of 25% on any and all business with the United States. So that's also coming out. And CFTC Chairman Michael Selig now says he's launching Innovation Advisory Committee on AI and blockchain. It just seems that tech is again the thing that's keeping us out of trouble here. AI and tech again, right?
I would say I go against that grain. If you look at the
Okay.
year-to-date performance, yeah, I mean, I love you, but I'm going to go against that grain. I mean, if you're looking at year-to-date performance, information technology is actually down almost 0.5%. Right now, what's leading this market? Industrial is up 4.3%, materials up 6.2%, consumer staples up 2.8%. I'll go with one more here just to kind of reinforce consumer discretionary up about 3.7%. Now, we're only like maybe 8, 9 trading sessions into the year, and we're seeing some pretty decent returns. So we're coming out a little bit hot here. But information technology, if you kind of look under the hood, I would say it's a little bit more split. You are seeing the memory names and semiconductors continuing to catch a bid. But if you're looking at the Mag 7 names, they're not really doing all that well. I mean, the reaction from Meta today after that news that they're laying off 10% of Reality Lab staff. I mean, look at that candle to the downside. You would think that the market would bid that up for a business unit that hasn't made any money. It's been kind of an endless money pit, and that they're going to refocus their efforts elsewhere. That stock was down 1.7% today. Nvidia up only flat on today's session as well. If you're looking at Alphabet, up about 1%. That's the only one that's really showing on some pretty decent strength here. And I'm going to look at Tesla because that one actually saw some aggressive selling pressure last week, maybe trying to cut. So going back and just saying Tesla is more consumer discretionary, but you get the gist here. I think right now what's holding us up is the broad trade.
Mm-hmm.
Now, Stephen, people get concerned about that. Oh my gosh, consumer staples are leading the market. It depends on the context.
I
Like
kind of feel
consumer
that way
staples
though,
have been
right?
thriving for 2 years.
But that's the kind of products that shouldn't be holding the markets up, right? But unless you I guess include Apple and things like that. But all right, let's get right to it. Talk about consumer staples and consumers themselves.
Yeah.
Trump has come out and said, I'm going to lower credit cards to 10%. Can he do it? I'm not sure he can do it by himself. I think he needs to act to Congress, I think. I don't know. But I was happy about that. And yet Citibank not down that much today. And then Citigroup today says they're going to lay up 1,000 people. So what's the back and forth on this? I mean, I'm confused in the banking sector right now.
I think you and everybody else.
Okay, good.
It's a unique situation because here's the thing. You are right. From what I've read, Congress has to be the one that actually takes action in order to produce a cap, right? Similar to what we've seen as far as the measures during COVID-19, which obviously was an emergency situation, but there were certain measures that were put in place on the financial front because of COVID and other events. To unilaterally do it, I don't think we'll see if it actually comes to fruition. I think that you probably will get a company or two that actually does push back because you're talking about adjusting an overall portfolio of in your balance sheet in a matter of 8 days. That's a very tough thing to do for any company to do, let alone a credit card company, because what's going to happen, what may happen is that, okay, we get this cap, it's 10%. You're also going to see credit availability immediately dry out for a significant amount of people because they're going to have to barbell it. They're not going to continue to they're not going to keep your credit limit at $100,000 and then move from, let's say, 20% down to 10%, but keep your credit limit that high. That actually increases, just mathematically speaking, for you and statisticians out there, that increases their risk ratio right on their own portfolio. So they're going to have to barbell it. So they get lower interest rates, they're going to have to actually lower credit availability for potentially within their portfolio. And I think that actually could have an impact when it comes to consumer
Yeah, and I mean at that point
just
the
in
bank
general.
could be like, screw you, I'm not gonna lend to anybody at that point. You gotta be
Well, they have to.
Oh, they have
Well,
to.
you're gonna have a problem. So if it is true, and they are going to make this adjustment in the next 8 days, who knows if that's going to happen? Everything, when you're looking at the credit markets in general, we have to be everything is securitized. Everything is collateralized in one way, shape, or form, right? Like even if I have a credit card with XYZ bank, they may have already packaged and shipped that off to somebody else that's buying it. And there's paper moving, all of this exotic paper. What you could actually also then have a situation where who wants to buy, who wants to sell, who's going to keep assets on their book. Now you may have something that you have to get a lower interest rate on. You may have purchased some paper that you were expected to get, let's say 15% return on. Yeah, you're going to take some risk. Now you're capped at 10%. What happens to the value of that asset or that debt, right? Goes down, right? It's just fundamentals, right? We're not even speculating.
I
That's
mean,
exactly how
you're
it works.
talking 2008 stuff. You're starting to scare me there, Kevin.
But the other side of this, and I'm not. Look, if you want to charge me 10% on my credit cards, I'm all for it. Keep my credit limit. what also could also then happen is you see different structures being put into place potentially, right? So higher fees when you have a credit card, right? Maybe you get charged 10%. Maybe you have that platinum card that's what, $800 a year or something like that.
Right.
I don't know, $1,000 a year. I think it's
600, yeah,
$800 now.
something like that.
Yeah, 600, 800. So what if they double that now, right? To make up,
Well,
they're gonna have to make it
I'm
up.
not
They're
looking
gonna have to
forward to
close.
that, right? Now, I'll tell you when I get that comes at me and I just said I'm not paying it, they just give it to me anyway, right? So I'm okay with that. All right, let's get to it. When you look at the overall market right now, all-time highs, gold, all-time highs, silver, all-time highs, commodities starting to move on the highs again. Like something's got to break. Normally in the normal markets, things break and things are breaking. If something were to break, what do you think is the telltale sign that people should look at and go, okay, I need to get the hell out of this thing. This thing is starting to scare me, but you don't see that yet. What is it that you're looking for that might go, you know what? This is not the market I want to be in. I started going to cash on Friday, Thursday and Friday, which I already did. I raised about 24% now on the trading portfolio because I'm nervous about the more boots on the ground, more troops, and more Cuba being next. And what's the thing that I don't know, the black swan behind the left door, right? What is it that's bothering you that could really get to you that I got to get the hell out of this market?
Yeah, well, okay, so if you're kind of looking at, so you know me, I'm a commodity guy. So what am I going to look at? I'm going to look at the higher beta plays first to see if they break down. So if you villain froggy, the highest beta trade that you got right now on the metals front is actually going to be palladium. And so if that one is going to be the first one, I mean, palladium can move 10% in a day, no problem, right? If you see palladium break 15, 18% in a day, and that might be the case where, okay, well, maybe this metals trade is coming to an end here soon. I'm going to look next at silver. It's a higher beta trade to gold. What happens with that trade? Do you see any type of fundamental breakdown? Silver is actually a really decent leading indicator. If you look at if you overlay silver to the technology sector, or if you overlay silver to, let's say, an NVIDIA, there's actually a very strong correlation. Now, it's broken down here a tad bit over the last 3 months or so, but this time last year, you were sitting at around an 83% correlation if you take out seasonality, right? Across correlation, if you will, if you're looking at one of those studies. So silver is actually a really decent leading indicator for not only economic growth, but also equity growth. And so I think that's, once again, kind of coinciding what we are seeing with the equity front. You start seeing silver break down here a tad bit, that's when you get a little bit more concerned. And then I always go back and look at the high yield credit spreads. You start seeing those widening out or basically moving to the upside. Maybe that's going to be something on the radar. You'd be mindful, the volatility index right now, VIX sitting at what, 15 and a half or so. Generally around the 18th is usually when we start seeing volatility actually re-rate to the up. You're going to have quarterly expiration, or I'm sorry, you're going to have monthly expiration this Friday. That'll be the first kind of tranche. You'll have some VIX expiration that'll also kind of roll off and readjust as well. And then you have the preparation for the Fed meeting. You have retail sales this week. You have CPI. You got PPI. I don't think the inflation prints are that big a risk, but what I'm looking at is going to be retail sales. The control group, if that does come in actually fairly weak, that's where you get a little bit more concerned that the fundamental landscape is not looking that great. And I know that we're probably coming up on time, Stephen, but I want to highlight something here real quick. Everybody that I've seen over the last week, and I was out last week, right? I'm always out when things hit the fan, which is always great. But I see a lot of people starting to cite the Atlanta Fed GDP now forecast was 5% or something of that nature, 5.4%. It's probably gotten readjusted right now. And they're citing this as, man, this is the strength of the U.S. economy. And that's just really not the case. You can look at the underlying inputs for the Atlanta Fed GDP now, and all of that growth is really coming from gold and silver and metal exports out of the United States. And I think that is kind of that first signal that for me, that maybe we're getting towards the end of this metals trade. Now, you never never try to get in front of a freight train, but let me just kind of break down the timeline of what we saw this time last year. This time last year, we saw a massive uptick in exports. I'm sorry, in imports of gold and copper coming into the United States to try to get ahead of any type of tariff policy. And to the point where obviously we did create a pretty decent deficit on the LME front. You started having this physical short squeeze. You and I kind of talked about that. This physical short squeeze that took place. You started seeing gold move to the up. The next one was copper that took it, and then you started seeing silver exports or imports coming into the United States, creating that short squeeze scenario. During Q1 and kind of residual of Q2, what do we also see? We saw actually a negative GDP print, and that's because of that gold and metals trade. It has so much weight when you're looking at GDP that it was a negative in Q1 of last year. Well, guess what? Now it's a positive. That's why we are showing 5% growth, 4.5% growth. If you look at the import-export data that came out, I believe last week, if I'm not mistaken, you guys can look it up. Look at all the net components. The only thing that was net positive was actually the physical movement of metals that were outside of the Federal Reserve. And so consumer discretionary goods, yet net negative, right? Everything. So there's a narrative, and the market's trading on this narrative that the consumer's fine. We're at 5% or 3% or 4% GDP growth. But if you actually look under the hood, it's not really supported. Just like it was not supported for the bear case last year early on, where we were printing negative, what was it, 2.5%, 3% GDP. And everybody was like, look, the economy's falling off a cliff. And it's like, that's not the case. And so I think that dynamic is going to be key. And I want to capstone it. The reason why, if we start seeing exports of those metals again, that means that we probably are then seeing an equilibrium within the supply market.
Okay.
And that's probably when we start seeing these industrial companies might start saying, hey, there's some demand destruction here. We might be good, and we might have that equilibrium. And then if we do get that tariff policy update from SCOTUS on Wednesday, and they do knock down those tariffs, the big risk for silver and copper is tariffs, right? Copper kind of got a little bit away from it because cathodes are not included. But if they strike all of that down, that also could lead to a little bit of an unwind of that metals trade on the copper and silver front. And that's something I'm keeping my eye out on. So I know it's a long answer, but I think it's very important for us to kind of
it's a great answer.
What's happening.
Yeah, and you look at Atlanta GDP is now saying 5%, and I saw Kathy Woods over the weekend talking personally and saying 7.5% growth this year. I mean, that's some big talk, and we have never seen that kind of growth in this country in decades, not much, maybe even 100 years, I think. All right, Kevin Green, yeah.
It's not. It's a synthetic growth. It's not. It's not
real growth. It's fake news growth. I love it. All right, Kevin Green, Schwab Network, man. Thanks so much, and welcome back. Glad to have you back, man. Kevin Green. Everybody, give a quick follow there. KG Bull and Bear right there on X.com. And Kevin, we'll see you right back here next week, my man.
Thanks, man. Appreciate you.